Okay, in this video, we're going to go through an example of the DTA valuation allowance. We're going to learn a little bit about what information that conveys to you. So the deferred tax asset valuation allowance. Companies must establish this valuation allowance for deferred tax assets if the future realization of the tax benefit is uncertain. The allowance is going to reduce the reported asset and increase tax expense. So let me show you an example of this. In the example I'll use is a tax loss carry forward. This is a rule in the US where you can carry forward your losses to avoid future taxes. So suppose it's 2023 and we're filling out our tax return for the year and we had a loss for the year of $100. Well, when you lose money, you don't have to pay taxes. You don't have any taxable income, so you pay zero in taxes. So taxes owed at 21% tax rate, suppose, is zero. Now let's suppose the following year and we don't have a carry forward rule. So suppose in the following year we have income of $100. Well, in that case, we have to pay taxes on that income. We can't carry forward our prior loss. And so we end up owing $21 on that $100 of taxable income. That's without a carry forward benefit. Now let's impose the carry forward rule. Imposing the carry forward rule, I can carry forward this loss that I incurred in the past, and I can use it to offset future income. Now that reduces my current taxable income from $100 down to zero, because last year's loss offsets against this year's loss. I have zero of taxable income this year, and now I don't have to pay any taxes. And as I flash backwards, I paid $21 without the rule. I pay $0 with the rule. And so this is a $21 benefit to me because this rule exists. Now let me show you the journal entries behind how a company would account for this benefit. Suppose the company had no permanent tax differences, and so we just have a pre-tax GAAP income or loss, in this case, of $100 in 2023. What will we do in this case? Well, in this case, we're going to create this asset, this $21 asset, because we figure we're going to be able to use this $100 loss to offset against future income. So we'll debit the deferred tax asset account and we'll credit tax expense. Now, normally we are debiting expenses, right? This time we're crediting an expense account. So that's the opposite of what we normally do. It's going to be a negative tax expense in that case. So what's our income statement going to look like? We're actually going to show something called a tax benefit on our income statement. And so rather than tax expense, which would be positive, we have a negative tax benefit here of $21. And that is going to reduce the magnitude of the loss on our income statement. Now, when we look at post-tax net income, it's only negative $79. That's because we're including this $21 benefit that we think we're going to be able to use in the future. So what does our footnote look like? Well, our footnote lists this $21 asset that we think we'll be able to use in the future. We get to avoid $21 of taxes in the future. And we call it a deferred tax asset in our footnote, and we call it the NOL carry forward. And that's the value of the asset there is $21. Now let's note, importantly, what do we need to happen to be able to use this $21 asset? Well, what we need is we need at least $100 of future taxable income. Because we have this $100 of loss that we can carry forward to offset future income, the only way that's going to benefit us is if we have $100 of future income. If we don't, we're never going to be able to use this tax loss carry forward. So this $21 asset, it only has value if we think we'll earn at least $100 of taxable income in the future. What do we do if we don't think we're going to have $100 of taxable income in the future? Well, then we can't recognize this asset. We have to record a valuation allowance against it, reducing it to zero, if we don't think we'll have enough income in the future to use it. What do the journal entries for that allowance look like? Well, we're going to credit this contra asset account called the valuation allowance, okay? And that's a contra asset and it offsets our asset to zero. And at the same time we do that, we debit tax expense on the income statement. So now we have a debit to deferred tax assets and a credit to deferred tax assets. And so we've got zero in deferred tax assets. And we've got a credit to tax expense offset by a debit to tax expense. And so now we're going to have 0 of tax expense on our income statement. And now that loss of $100 is just as painful as it was before we thought about taxes. It's a $100 loss rather than a $79 loss. And so the important part we learned, I hope, here today in this video is that our decisions around management's decisions around whether or not to recognize a valuation allowance on our deferred tax assets, it communicates information about whether management expects to be profitable enough in the future to use these tax assets. So it communicates information about management's expected future profitability. Let me show you a real-world example. This is a company called Tableau that makes software packages for businesses. Now it's owned by Salesforce, I believe. So here was when Tableau was a standalone company, they had an earnings announcement. And this was for Q4 of 2015. Okay, so they're reporting it in February of 2016, but this was for their Q4 of 2015 fiscal quarter. This company, FactSet, reports data to investors. So I'm the investor, and I'm learning about the performance of FactSet for the quarter. Now, Tableau is reporting Q4 earnings per share EPS of 33 cents. It says X items, okay, which is going to include a certain charge we're interested in. So that 33 cents of earnings per share compares to what analysts were expecting. So FactSet is averaging analyst expectations. Analysts were expecting 16 cents per share. So this 33 cents comes in at better than the 16 cents per share that analysts were expecting. Revenue is also better than we were expecting. It's $202.8 million. Analysts were expecting $200.8 million. So it's kind of looking like good news based on these summary items. But this X items is important. It's excluding a tax charge that we're going to be interested in, okay? So even though earnings excluding this item beat expectations, revenue beat expectations, if I compare the stock price around the short window that this earnings announcement was announced, if I compare it to the S&P 500, which is this green line here, which I just drew a blue line over, well, the blue line that was there all along is the Tableau line. And you can see that the stock price dropped significantly. It cut more than in half. You see that it was around $85 before the earnings announcement, and it's around $40 after the earnings announcement. So the stock price took a huge hit despite the earnings beat and the revenue beat. So why did earnings take a huge hit? Well, when you go to the company's footnote on their income taxes, here they're listing their deferred tax assets, and they've got different types of deferred tax assets. They've got tax credit carry forwards, similar to what we talked about in our example, and they've got other types of deferred taxes. But they also did what? They've got this valuation allowance. And in 2014, they didn't have a valuation allowance on these assets. They thought, okay, we've got all these deferred tax assets. We're going to have enough future taxable income to be able to use these assets in the future. Well, something changed between 2014 and 2015 because in Q4 of 2015, they recognized a huge valuation allowance, reducing the deferred tax assets almost to zero. So why did they do that? Well, if you ask the CFO, Thomas Walker, here's what he said. We recorded a $46.7 million valuation allowance against our U.S. deferred tax assets. We now have a 3-year cumulative GAAP net loss adjusted for permanent tax differences. It's not likely that we'll have sufficient taxable income on a tax basis to utilize our deferred tax assets. This allowance is a non-cash charge. It doesn't have any impact on cash flow, except it communicates significant information about whether management thinks the company is going to generate taxable income in the future. And he's saying, you know what? I don't think we're going to generate very much taxable income in the future. We're not going to be very profitable in the near term to be able to use these tax assets. So here's just the stock price history of Tableau. They were doing pretty well for a while. And then here's where the announcement came out, where they had low expectations about future profitability. And we can't feel too bad for Tableau because since that point in time, their stock price increased in value and eventually they got bought out by Salesforce, which is this stock price increase here. And so in this short video, we learned about the DTA valuation allowance. It's a contra asset. It reduces the net book value of the company's deferred tax assets. The valuation allowance exists when it's unlikely the company will generate enough future taxable income to use and benefit from its deferred tax assets.